After reaching its all-time high a month ago, the stock market had lost $5 trillion. Asset markets reflect investors' future expectations. Currently, those forecasts are dismal. Discussing the everything bubble for a while. Wealthy speculators who have nothing to invest in have driven up prices in equities, real estate, precious metals, and even meme coins. Take your pick if you wanted something to break this bubble. Trade wars, real wars, national and personal debt, mass layoffs, and government program cuts. The biggest problem is that no one knows what's happening. Since peaking less than a month ago, the market has gained $4 trillion. On February 19th, a federal judge allowed President Trump's widespread layoffs to continue while overseeing legal proceedings despite tariffs on Canadian and Mexican imports, a 25% to 50% tariff on steel and aluminum entering the US, and up to $400,000 per day. President Trump is reconsidering. President Trump eliminates tariffs on most Canadian and Mexican imports. Money loves certainty again. Investors and executives must base their decisions on credible future estimates. All company decisions, from hiring or firing staff to expanding a warehouse, releasing a new product or paying dividends, require someone to make a prediction about the quarter, year, and, for some CEOs, decade ahead. Businesses must play it safe by decreasing expenses, delaying the development of new, unproven items, and accumulating as much capital as possible to survive an emergency. Sometimes those estimates are right, so effective business managers should have a backup plan if no one knows what the following week or decade will bring. Active investors play safe by closing positions and switching to safe assets until they can repeat a market analysis. Even hedge funds, which often perform better amid market volatility, are ignoring the American hysteria. A Financial Times investigation found that these investors are reducing leverage and market exposure across the board, even though this is when they have the highest chance of outperforming and earning big incentives. All these patterns have a cause. Who knows what will happen next? Therefore, we must consider these charges. President Trump announced 100% tariffs on any nation that endangered the USD as a global currency before taking office. Colombia faced its first charges 6 days after the inauguration for refusing deportation planes. 3 days later, 25% tariffs on Canada and Mexico were proposed, along with a 10% duty on Chinese exports. Only Canada and Mexico had their implementation delayed by 30 days on the 3rd from the 4th. They countered with other charges after China's tariffs took effect. A week later, steel and aluminum duties replaced 2018 tariff exemptions. 3 days later, all nations are warned and reciprocal levies are declared for non-China, Canada, and Mexico. The Commerce Department must investigate copper tariffs 2 weeks later. The 25% tariffs on Canada and Mexico took effect 3 days later, with exceptions for energy, which was 10% levied. After Chinese import taxes were raised from 10% to 20%, all 3 nations imposed tariffs on a select American goods. The tariffs are lifted 1 day later, but only for automakers. After America's 25% tariff on steel and aluminum prompted the EU to threaten a 50% duty on American whiskey, Australia, the UK, and Europe were threatened with a 200% tariff on wine and champagne. The following day, the tariffs are delayed for 25 days, but take effect on April 2 and currently, these tariffs are likely to be delayed, intensified, renegotiated, or disregarded. Beware, but correctly applied tariffs can help regional firm growth, American employment, and important sectors. However, a well-defined plan must be implemented over time to allow enterprises to modify to maximize good benefits and minimize negative ones. While viewing this, you may be thinking that all of these on-again, off-again situations are just reactions. Tariffs. More trade policy changes have been announced in 2 months than in 10 years. In the past month, investors and businesses who are unsure of what to expect have sold off since playing it safe is the only rational course of action. I get your point, but so what? The tale has probably been told 100 times. Wealthy people will take the brunt of these losses because they own most of the stocks. Stocks are not the economy. This disaster could be a great opportunity to level the financial playing field between workers and owners. Unfortunately, the economy is not the stock market until it struggles. Learn about money, pumps, and coups now. Dump the exhausted economy. I want to make clear that you, me, anyone you watch online, business executives, and probably most of people making decisions are uninformed of what is happening. Businesses must address this issue since even planning for a bad future is better than none. It would be bad if all our major trading partners were hit with 25% tariffs. It would delay commerce, disrupt supply chains, and result in retaliatory levies that would lower our products' global appeal. Some of these expenses may be passed on to customers, but as you may have discovered, most customers cannot bear any more. Businesses may gradually respond by bringing supply chains onshore, negotiating with domestic suppliers, and focusing on US sales. Companies don't want to make significant investments if legislation will change again, as they'll waste their money. Automobile manufacturers make complex products with hundreds of parts and plants that take years to open. Thus, until they comprehend the long-term trading climate, they won't make major changes. Some businesses have ignored this trend, and not for good reasons. Large shops like Walmart have dramatically raised their stockpiles to keep their shelves stocked while these trade wars continue. This might let them outlast their opponents by weeks. Even at their current high levels, they can only retain so much inventory, and even if customer behavior were predictable, they would run out in 4 weeks. In general, too much inventory is bad for business. Spending hundreds of billions of dollars to expedite AI slot production may not seem like a wise investment, but even if the result isn't perfect, it can be beneficial. The other corporations are mostly IT companies that have invested heavily in data centers and energy infrastructure to develop AI in America. Recently, outlandish numbers have been bandied around. Tech companies are selling their own nuclear power plants online to meet their energy needs, which seems dystopian. But qualified technicians must build this infrastructure, which will create many jobs in a region that needs more funding. Major public investment announcements are free, which is problematic. Companies making announcements aren't usually legally bound by them. Apple announced $500 billion in US investments to create 20,000 jobs. Politicians who wanted to appear business-friendly embraced this. If you've been listening, it sounds strangely similar. In 2018, Apple pledged $350 billion and 20,000 jobs to the US economy. 3 years later, after Joe Biden's inauguration and the proclamation of more digital monopoly limits, Apple announced a $430 billion plan to create 20,000 American jobs. Apple is no longer alone. The majority of businesses do this. Apple fails at even trying to improve assignments. Additionally, Elon Musk has a history for making unrealistic promises and not delivering. He's doing what all other American tech businesses do, whether you like him or not. Just stepping up and announcing. How come they do this? 3 reasons, though. Firstly, it's an effective way to influence politicians from both parties. Love catchy headlines. Most individuals enjoy writing about their booming economy and significant investments that create jobs. Additionally, it lets people oppose undesirable rules. If you are the CEO of a company that will attract the FTC's attention, you could call your retainer politician and explain that you may not be able to make the large investments you planned if a law is passed or your business is investigated for anti-competitive behavior. Would that be awful? These announcements can also be used to obtain government co-investments or loosen laws so these corporations can invest without hassle. The second factor is forgetfulness. Except for sophisticated investors who won't care if the firm doesn't spend $500 billion on PR and instead buys back stock, few people are interested in large corporations' 5-year budgets. The third reason is stock price increases. A corporation investing heavily in a fast-growing industry shows regular investors that A, it has $500 billion to invest, and B, it is confident in its future. Businesses benefit greatly if they can simulate huge investments without including them in their financial accounts. Due to the idea of endless growth, these enterprises have become quite pricey in the past decade. To pick on Apple, its valuation has soared by nearly 330%, while its profits have only increased by 80%. Last week, we discussed stretch valuations, but I forgot to mention that this only works if people expect even the greatest firms to keep growing rapidly, which is becoming harder. Thus, this market meltdown may represent a buying opportunity for new investors, or a correction of investor expectations. There are concerns with this idea. First, you don't want to ruin the flight by making bad financial decisions, and buying the decline is like timing the market, which most investors should avoid. The bigger concern is that family savings are nearing record lows, and because businesses must answer to shareholders, they will likely continue to lay off workers to cut expenses at this uncertain period. Not to mention the government personnel who lost solid jobs. Seeing the world's wealthiest people's net worth drop due to the market may be relaxing. Despite their theoretical market exposure, they will likely be better prepared than most households to weather economic turbulence. Warren Buffett's Berkshire Hathaway has amassed hundreds of billions. Therefore, Buffett will prefer buying the dip. Old man. For the rest, no. Even if the stock market consolidates, a market crisis may allow average people to invest in a growing asset market. If real estate investment slows, home buyers may profit. Watch this video to see why even if prices decline. Unfortunately, real estate crashes rarely help you. Like and subscribe to learn more about money.